Hi, everybody. This is Maliha Bengali at MB Commodity Corner. We'd just like to take a little bit of time to talk about the oil markets and commodities, where we see them going to Q2 and for the remainder of this year, as commodities have become a very sought after topic, especially given the Fed rhetoric at the FOMC just last week. There's a lot of talk about inflation and what the Fed is intending on doing with interest rate policy. We'd like to take a step back and talk about exactly what was said by the Fed. We think the Fed has completely gone off script over the last 6 months, because usually if you follow the data, which has actually been picking up in Jan and Feb, you'd imagine the Fed would start talking to be a bit more hawkish, but they actually have maintained their dovishness and are maintaining their 3 rate cuts for this year. In December last year, when the market was pricing close to 6-7 rate cuts, the Fed actually was still on the side of caution, and they sort of caught up with them and talked about 3 rate cuts. But as you've seen the data in Jan and Feb, it's showing signs of slowing down, cooling off, which probably predicates the fact that the Fed needs to cut, because the real economy is very, very different from the markets. We see S&P making new all-time highs year to date, of which 20% is driven by technology stocks. But what's really happening in the banking system, the U.S. consumer, housing prices, industrial production, or retail sales, there's a massive slowdown. And what's interesting is that we've seen a massive sort of slowdown, but at the same time, prices paid, inflation has ticked higher. The US is now, according to the Fed, the US is now going to be growing at a GDP of 2.5%. Inflation is below 3%, not at that target of 2%. And employment is, firmly below 4%, but yet they're talking about 3 rate cuts. So we sort of wonder what the Fed knows that the market isn't, and why they're maintaining this sort of dovish bias when they should be more hawkishly biased, as in the past they've done so. Then window is actually closing in very, very quickly for them to do so if they need to cut rates this year, because it is a US election year. And if they don't cut rates by May and June, then the window might be shut for them, because they cannot be seen to be political. Even though the Fed claims that they are not political, we know that, deep down there is some sort of an incentive to keep the markets, sort of well supported. But the fact of the matter is that right now the economy would suggest that rates would need to be cut, but the inflation data does not suggest. And this is why, like, our cross-asset models have been showing sort of, stagflationary trends for a long time right now. And we think the Fed's pretty much in a very sort of tough dilemma, where if they cut rates today, inflation is going to go through the roof and get back to above 3.5%. And once inflation goes out, it's very hard to contain it. But then you have the US economy right now. We have borrowed so much money. We're now about $36 trillion in debt. We're borrowing from the future to fund the growth right now. After COVID, the massive fiscal spend, the US economy is now growing, but yet it's now showing signs of slowing down. So what we need to do is print even more, cut rates even more. Where is it going to go? How is it going to end? The US interest expense is, above $1.2 trillion. So the Fed needs to cut rates to be able to afford that. But then at the same time, they can't. So the economy really is moving 2 different directions right now, where we just keep on printing and cutting rates and providing the stimulus to get the economy to stay, avoid recession. But as you see in the rest of the world right now, with China, a technical recession in UK, Japan, Germany, US is the only economy that's been holding up, but to what extent and how long will the Chinese weakness actually not sort of filter into the rest of the world and take it down? So today we take a step back and we take let's look at the oil price. This is the chart of the Brent oil market. We've seen sort of averaging. It's been quite boring. It's been trading between $70 and $90 a barrel really for the last 2 years. OPEC Plus has done a great job in terms of supporting the prices and kept about 5 to 6 million barrels per day of oil out of the market. And given the demand slowdown, if they hadn't done that, oil prices would be trading somewhere between high 40s to mid 50s, but OPEC cannot afford that. As we know, they've spent a lot of their sort of future earnings in future projects to diversify sort of with oil and gas revenues. They have very aggressive ambitions and plans for the future. And for that, their budget break-even is probably close to $95 a barrel rather than, these prices right here. So OPEC needs a much higher for longer oil price environment. And that's why they've sort of kept the markets really sort of pinned at these levels, and oil's been trading this range. But does that mean the oil price will sort of go much higher? The chart here on a technical basis, see how we sort of rallied here, and in the start of the year, oil price is up 10%. We can probably see this triangle wedge pattern to hit towards $90, but there's a lot of pressure around this $85 per barrel mark right here. So we be cautious in chasing oil prices here, because technical analysis are important, but we spend a lot of time looking at the actual demand supply inventory balances. So take a look at the next chart right now. This is heating oil. Heating oil is something that is what we use to in the wintertime. There's used to heat oil, heat houses. We use distillate prices into manufacturing, the economy. Most people who trade oil prices don't really know what products are doing, but the thing that drives oil is actually products, whether it's heating oil, gasoline, naphtha, distillate, whatever have you. And as you can see here, the heating oil prices really have not been doing anything. They've actually just been sort of trading down, and that's really why oil prices have been so muted. Demand has been really weak for heating oil prices. Now, in terms of, we've seen in the news recently how Ukraine has been targeting Russian oil refineries. That's interesting because obviously they were hitting it right where it hurts. And that caused a surge in refining margins, which saw sort of the rally in oil prices. But we've seen that sort of come back down. The US is sort of warning Ukraine about targeting key infrastructure targets because it actually hurts the US consumer. Higher gasoline prices, higher product prices is not something that Biden wants going to the US election political year. So it's interesting. So this is really one of the reasons why the oil prices have not been able to rally, because demand has been really soggy, and commodities are all about inventory balances, demand supply balances. It's not about how cheap it is, how expensive it is. It's about how much we have of it and how much we need of it. So the demand is very, very important, and the demand's just not been there. But having said that, every sell side house has been pushing sort of equities and other sort of markets on this supposed Chinese recovery that is still not come into play right now. The next chart we show here is the Chinese equity market. We can see how every time it tries to rally post a reopening, so they provide the stimulus, but just sort of fizzles right out. And this year now we've seen the PBOC do the short selling ban, provide some sort of loans to infrastructure vehicles, try to get the actual domestic consumer to grow and spend, but to no avail. The slowdown in China is so real right now. The property market weakness is so evident that the domestic consumer just is not incentivized to spend or buy another house or anything of the matter. There's a massive secular decline in China right now. And no matter what the government's talking about, it's just not as enough, because they can't print anymore. Every time they print, the currency falls even more, and the yuan's going through a massive currency crisis, because you can see with the yuan weakening against the dollar, we're trading close to 7.2 versus dollar right now. The PBOC in China actually has its hands tied as to how much they can print to keep the economy afloat. And the big question we have is, when will that sort of filter into the rest of the world? Because we know that when China sneezes, the rest of the world catches a cold. And out of all the economies, the US is the only economy that's holding up because of its massive fiscal spend. And we know that even that's sort of showing signs of slowing down, because it can't keep going on forever. Powell's talked about how this sort of fiscal spending is on an unsustainable path as well. But we'll see how that sort of plays out. But China really needs to do something, and they cannot print any more money right now because the yuan's going to be completely sort of depreciate and devalue, and they can't afford that. The other sort of commodities focus on China, exposed to China, are something like nickel. You can see the nickel market. It actually has been in a massive downward trend, tried to rally and fell back down again into April. You've seen something like, iron ore. Iron ore is something that goes into making steel, and China is one of the world's largest steel producers. And then sort of seasonally, we saw a pickup in iron ore prices as they made more steel, but even that's showing signs of cooling off. So everything we take a look at from a cross-asset model shows that China is not really picking up. Demand is being weak, but yet everybody's waiting for this Chinese recovery to take oil higher, iron ore prices, copper prices, everything higher. Yes, if the Fed does cut interest rates, it'll be interesting because inflation is going to trigger these commodity prices to go higher, but it's not that simple. There are key sort of arguments as to when is the Fed going to cut, and where's the demand supply for each commodity as we go into that rate cycle the rate cutting cycle. We spend a lot of our time looking at each commodity market to see which inventories are tight, and so we sort of time our macro tailwinds with the micro tailwinds to get into that sweet spot and sort of play that discrepancy. And that's what we do. We spend a lot of our time looking at bond markets, equity markets, credit, FX, other markets, see what the themes and economic cycles are being priced in by each asset class, and then sort of see which asset class has been misrepresented and mispriced according to that theme. And that's what we do. The sweet spot, as you mentioned, is looking at top-down analysis with the bottoms of physical market indicators to really sort of time in on those pricing discrepancies. As our readers know, please do, if you would like to get some more information, clicking on the link in below. You can send an email to info@mbcommoditycorner.com or subscribe to our Substack channel, where we send out a daily newsletter on action, buys and sells on oil, copper, gas, aluminum, and all sorts of things right now. And we think Q2 will be very, very interesting. But being cheap is not enough. We've seen US gas markets, they're trading at below $2 per MMBTU. The charts look very cheap, but end of the day, there's just too much of gas. We had a record winter, warm winter this year, which never usually happens as much as it has. Then we had ample inventory, we had demand sogginess, which is why gas prices have not rallied. And this is really what is important to determine the demand supply balance going forward, because it is a dynamic process and it just can't be taken at face value. Having said that, if you do see the US avoid a recession, we see a massive of pickup in demand from the rest of the world, OPEC may be very, very lucky and get higher prices because they've deliberately kept that oil price out of the market to get higher prices. But is it going to be that easy? We discuss all this and more and really talk about what drives oil prices and where we see oil prices going into the next quarter. But for now, we are really worried about signs about across asset models showing stagflation. Demand saw rolling off, but inflation is staying high for longer, which is to the Fed's detriment. And that actually is not as good. Is not a good environment to trade for equities and bonds. And the market setup into Q2 is interesting because everybody's very, very long right now. Yes, there's talk about the commodity and technology rotation, which can work really well in an up cycle, inflation cycle, but timing is very important. And that's what we spend our time on in terms of when to time our trades on the long and short side. We hope you enjoyed this video and we look forward to seeing you the next time. Thank you. Bye-bye.